Good morning, everyone, and thank you for joining this presentation. And today we will be conducting a deep dive into the September 2025 Federal Open Market Committee, or FOMC, meeting and its profound impact on the gold market. As you can see from our title slide, our focus will be on analyzing the Federal Reserve's latest policy decisions and dissecting the subsequent and quite dramatic market reaction, particularly in the price of gold. The events of September 17th have sent significant ripples through the financial world, and our goal today is to understand the underlying drivers, assess the immediate aftermath, and formulate a strategic outlook for investors. We will explore the nuances of the Fed's announcement, the key messages from Chair Powell's press conference, and the resulting volatility that saw gold reach a new all-time high before a sharp reversal. Let's begin. The Federal Open Market Committee decided on a 25 basis points rate cut, setting the federal funds rate target to 4.00% to 4.25%. Milan dissented, favoring a 50 basis points cut. 9 officials anticipate 2 more cuts this year. Employment downside risks have increased and inflation remains elevated, highlighting the Federal Reserve's balancing act between inflation and employment. Chair Powell emphasized a cautious, data-driven approach to rate cuts, highlighting slowing economic growth and a weakening labor market. Inflation is projected at 2.7% overall, with tariffs adding 0.3 to 0.4 points to core personal consumption expenditures. Powell reaffirmed the Federal Reserve's independence, underscoring the limited impact of individual votes on policy decisions. Now let's turn our attention to the market's reaction, which was nothing short of dramatic. The initial response to the FOMC's rate cut was a surge in the price of gold. The market initially interpreted the move as a dovish signal, and we saw gold prices spike to a new all-time high of $3,707.40 per ounce. However, the rally was short-lived. As Chair Powell began his press conference and delivered his more cautious, data-dependent message, the sentiment quickly reversed. His characterization of the cut as a risk management move, rather than the start of a sustained easing cycle, poured cold water on the market's initial enthusiasm. The result was a sharp reversal, with gold prices falling by nearly $60 from their peak. The market closed with gold at approximately $3,658.25 per ounce, a significant drop that wiped out the day's earlier gains. This volatility underscores just how sensitive the market is to the nuances of Fed communication. Gold's resilience is bolstered by an inflationary easing environment, where historical data shows a 13% average annual return when the Federal Reserve cuts rates with inflation above 2%. Central banks' strong gold purchases now surpass United States Treasury holdings, indicating a shift from dollar assets. Additionally, a 10% decline in the United States dollar supports gold prices, with institutions like Deutsche Bank setting targets at $4,000 per ounce. While the long-term fundamentals for gold are positive, it is crucial to be aware of the potential risks, particularly in the short term. The market is not without its challenges, and a prudent investor must consider the downside scenarios. The most significant risk at present is the overcrowded nature of the market. Many analysts are warning that long positions in gold have become excessive. This creates a situation of vulnerability. If market sentiment were to shift, it could trigger a rapid and large-scale unwinding of these positions, putting significant downward pressure on prices. Fed policy uncertainty is another major risk. As we saw from the market's reaction to Chair Powell's press conference, any indication that the Fed will be less dovish than expected can lead to a sharp sell-off. If future data comes in stronger than anticipated, or if inflation proves more persistent, the Fed may be forced to adopt a more hawkish stance, which would be a headwind for gold.
Market sentiment itself is a source of volatility. The rapid price swings we witnessed post-FOMC are a clear indication of how emotional and sentiment-driven the market can be. This makes gold susceptible to sudden shifts in investor psychology. Finally, from a technical perspective, gold is facing significant resistance after reaching new all-time highs. This could lead to a period of profit-taking and consolidation as the market digests its recent gains.
Monitor economic data closely, focusing on inflation and employment indicators, as they will guide the Federal Reserve's policy decisions. Gold remains a strong medium-term inflation hedge, supported by central bank demand. Diversify portfolios to manage Federal Reserve policy uncertainty, while being cautious of short-term volatility due to overcrowded gold market positions. Long-term, gold's value as an inflation hedge is significant. To conclude, let's summarize the key takeaways from our analysis. First, the Federal Reserve has adopted a cautious, data-dependent approach to monetary policy. Chair Powell's risk management characterization of the recent rate cut has introduced a significant degree of policy uncertainty, and we can expect the Fed to proceed with a measured pace of future adjustments. Second, despite the short-term volatility, the fundamental outlook for gold remains strong. The combination of an inflationary easing environment, robust central bank demand, and a weakening US dollar provides a powerful tailwind for the precious metal. Third, we should expect continued market volatility in the near term. The gold market is currently characterized by crowded positioning, which makes it vulnerable to rapid shifts in sentiment. Investors should be prepared for price swings as the market digests the Fed's policy path. Finally, in this data-dependent environment, close monitoring of economic indicators is paramount. Inflation and employment data will be the key determinants of the Fed's future actions, and staying informed will be crucial for successful navigation of the markets. Thank you for your attention. I am now happy to answer any questions you may have.